Most people believe the stock market is complicated, risky, and controlled by experts who know something they don't. And if you've ever felt like investing is a game where normal people are always a step behind, this video is for you. So before we go any further, hit like. If you want honest money advice without confusing jargon, subscribe for clear, no-hype investing education, and comment truth if you want to understand how the market really works. Because what I'm about to share is not talked about enough, especially by the people who are supposed to guide you. Here's the truth. Most financial advisors never clearly explain. The stock market is not a place where you get rich quickly. It's a system designed to reward patience, discipline, and long-term behavior. And the reason so many investors are disappointed is not because the market failed them, it's because their expectations were unrealistic from the start, usually shaped by headlines, social media, and success stories that hide decades of work behind a few lucky moments. Another uncomfortable truth is that your financial advisor does not wake up every day thinking about how to maximize your wealth. They think about managing risk, compliance, and keeping you invested long enough so you don't make emotional decisions. And that's not because they are bad people, it's because the financial system is built to prioritize stability over maximizing returns, which means many advisors focus more on preventing mistakes than on teaching you how money actually grows over time. One thing advisors rarely explain clearly is that market volatility is normal and necessary, because without ups and downs, there would be no long-term returns. And when the market drops, it doesn't mean something is broken. It means the system is doing what it has always done, creating opportunities for patient investors while emotionally testing everyone else. And most people fail this test because nobody prepared them for how uncomfortable investing feels in real life. Another truth people don't hear enough is that advisors cannot predict the market any better than you can, despite fancy charts and professional language, because countless studies have shown that long-term prediction is unreliable, and yet investors are often led to believe that someone knows what will happen next. When the reality is that successful investing is not about prediction, it's about preparation. Preparation means having a strategy that works even when things don't go as planned, because if your strategy only works when markets are calm, it's not a strategy, it's hope. And hope is dangerous in investing because it disappears the moment fear enters the picture, which is exactly why so many people sell at the worst possible times. Another rarely discussed truth is that fees matter more than most people think, and many advisors avoid this conversation because fees are how they get paid. But even small percentage fees quietly eat away at your returns over decades. And the painful part is that you don't notice this happening because it happens slowly, year after year. And which means understanding costs is one of the most important skills an investor can develop, even though it's not exciting. What your advisor also may not clearly explain is that complexity does not equal sophistication. Many investors assume complicated strategies must be better, but complexity usually increases confusion, stress, and mistakes, while simple, diversified strategies often outperform over the long run because simplicity makes discipline possible, and discipline is what drives results, not complexity. Another truth most people overlook is that your behavior matters more than your investments, because even a perfect portfolio will fail if you abandon it during emotional periods, and advisors know this, which is why their job often becomes managing your emotions more than your money. But instead of hiding this reality, it's better to understand it, so you can design a system that protects you from yourself. Let's talk about a major misconception around diversification. Many people believe diversification limits returns, when in reality it protects you from disasters, because the goal of diversification is not to maximize gains in the best year, it's to ensure survival across bad years. And survival is what allows compounding to continue, because compounding only works if you stay invested. Advisors also rarely talk about time enough because time doesn't sound impressive, but it's the most powerful force in the market, and people often underestimate what consistent investing over decades can achieve, while overestimating what short-term strategies can do. which leads to disappointment and constant strategy changes. And another uncomfortable truth is that most investors don't fail because they chose the wrong assets. They fail because they quit too early, switch too often, or chase reassurance instead of following a plan. And this behavior is encouraged by media, predictions, and noise that make investing feel urgent when it shouldn't be. What you should really understand about the stock market is that it's not designed to feel comfortable. If it was easy emotionally, everyone would succeed. And the discomfort you feel during market drops is not a sign of danger. It's a signal that you are doing something difficult that most people can't handle long term. One of the most valuable things you can do as an investor is lower how often you interact with your portfolio. Because checking prices constantly increases emotional reactions without improving decisions. And a simple rule is to focus on contributions and consistency rather than daily price movement, because what you control matters more than what you observe. Another truth advisors don't emphasize enough is that financial independence is built slowly, not dramatically. And the quiet progress of regular investing doesn't make headlines, but it builds wealth far more reliably than chasing breakthroughs. And once you accept this, the pressure to do something fades, allowing better decisions to emerge. Here's something that surprises many people. Doing nothing is often the correct investing decision. Not reacting to news, not changing strategy, not panicking during drops, and not chasing trends. And because inactivity combined with a good system is powerful, while activity driven by emotion is destructive. The stock market is not a casino when approached correctly, but it becomes one the moment you treat it like entertainment, gamble on predictions, or expect fast results. And advisors know this, which is why they emphasize patience, even if they don't fully explain why patience works. The truth is this: the stock market transfers wealth from emotional participants to disciplined ones, not because it's unfair, but because discipline allows compounding to operate uninterrupted, while emotion interrupts it constantly. So, what should you actually do with this information? First, focus on building a simple, diversified strategy you understand. Second, minimize unnecessary fees. Third, prepare emotionally for downturns before they happen. And then fourth, commit to consistency instead of excitement, because excitement fades, but habits compound. And here's the most important takeaway from this entire video. No advisor, no expert, and no prediction matters more than your ability to stick to a plan during uncomfortable periods, because that skill alone will put you ahead of most investors. So take action now. Comment truth. If you're ready to invest with clarity instead of confusion, subscribe for honest investing education, and share this video with someone who still believes the market is rigged against them. And if you want to understand how to protect your portfolio during uncertain times, watch Is the Market About to Crash? My Investing Portfolio Strategy? Because knowing the truth is powerful, but knowing how to act on it is what builds wealth.